That basically wraps up, I think, the most significant market moves. The market reacted to the de-escalation, not just of war, but of the ratcheting down of the expectations for Fed rate hikes. I think now the odds of any rate hikes at all between now and the end of the year, not just between now September, but between now and the end of the year, it's about a coin toss, a 50-50 shot as to whether or not there are going to be any rate hikes at all in 2026. It's just that the Fed is not going into the market and buying those $10 billion of treasuries. The Fed is taking the $10 billion of treasuries from Japan and then creating the money and giving it to Japan. The crazy thing about it is the Fed is afraid, the U.S. government is afraid that if Japan is selling treasuries, treasury prices are going to fall. And so to prevent that, we create inflation. That is what the Fed did. They created more money, gave it to Japan to use to buy back yen to increase the supply of dollars in circulation. That is more inflation.
Financial markets recently experienced dramatic shifts as changing monetary policy expectations and surging commodity prices rocked global investors. Unprecedented macroeconomic turbulence is forcing a rapid realignment across precious metals, global currency markets, and traditional bond yields. Peter Schiff, a prominent economist, author, and seasoned financial commentator, asserts that the Federal Reserve is completely trapped, leaving the odds of any further rate hikes in 2026 at a mere 50-50 coin toss. He forecasts that gold and silver are entering an explosive bull run, predicting that silver has officially shattered its $50 ceiling for good and will rapidly climb back toward record highs. Schiff projects that gold mining stocks will deliver outsized gains, whereas Bitcoin will remain the slowest horse in the market. Investors who ignore these physical asset moves risk getting caught on the wrong side of an accelerating systemic currency devaluation. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
The real action was in precious metals, and I have been pounding the table on this podcast to buy gold and silver as they were near support. Gold was hanging out around 4,000 support for many, many weeks, couple of months now. A couple of times it dipped below 4,000, but not by much, and it never really stayed there for more than a day. And I kept saying 4,000 was support. You got to buy it. Well, this week, gold closed at 4,341, up 7.8% on the week. Silver had an even better week, up 12.3%, closing at 63.46. Now, it had support in the mid-50s to upper 50s. I kept saying that was support. I kept saying that I did not expect silver to trade back below 50, that days of sub-$50 silver were over, that this $50 ceiling that had restrained silver going back to 1980 and then again in 2011, that ceiling had been shattered, that resistance was now support, and I didn't expect anybody to get another shot at buying silver below 50, that you were going to have to pay up, and if you didn't pay up, you didn't get in. Now, of course, even 63 is still about half of the new record high that we set, I think it was the end of February of this year. So we're going to go back up there. But this is still a great time to be buying silver. The miners had an even better week. And again, I've been telling everybody to pick up these miners. They were on sale. The GDX was up 22% on the week. 1 week, 22%. That's like 3 years of decent stock market gains in 1 week. And that's why you don't want to finesse this thing and try to be cute. These stocks can really move. The GDXJ, which has a little bit smaller market cap than the GDX, up 25% on the week. Now, of course, there's still a long way to go. I mean, if you missed out on last week, it doesn't mean you can't buy the miners. I think they're still going a lot higher. But I have been saying on this podcast, week after week after week, buy these stocks. And this was a week that you were really rewarded if you did. Now, as I said, if you stuck with Bitcoin, I've been telling everybody, get rid of Bitcoin, get into the miners. Bitcoin was only up 3.7% on the week. It was up less than the NASDAQ. It was up half of what gold was up, a third of what silver was up. Talk about the fastest horse in the race. That's what everybody has been saying ever since Paul Tudor Jones made that statement. Bitcoin is the slowest horse in the race. If you're still on Bitcoin before they send it out to the glue factory, get off and get on a real horse. Hi-ho silver. Get on the silver horse, the gold horse, or get on the miners. Get out of Bitcoin. Now, strategy did bounce on the week, 9%, so not a bad move. But once again, another week, they announced on Monday, another week where they sold not only strategy stock, but they sold more Bitcoin to raise cash so that they can pay Stretch. And in fact, Michael Saylor came out on X and reposted something, I think, from the CEO of Strategy, that the primary mission of Strategy right now is to get Stretch to trade between 99 and 100. So forget about a fiduciary responsibility to maximize the gains of the common stockholders. Those objectives have now been subordinated to the preferred. So if you own MicroStrategy stock, your interests have been subjugated to the preferred. The real goal isn't to maximize the return for the common shareholders, but the preferred shareholders. And if we have to sacrifice and dilute common, so be it. So you're just a sacrificial lamb waiting to get slaughtered if you hold on to that stock. I mean, if you like Bitcoin, and you should like it, but if you like Bitcoin, then just stay in Bitcoin. There's no reason to buy a strategy because the company no longer is even looking out for your interest. They are willing to do deals that are dilutive. In fact, the year to date, I think Bitcoin yield now is down to 3.5%. It was 13.3% 2.5 months ago. And all these dilutive transactions have destroyed almost all of the Bitcoin yield that Saylor was bragging about generating earlier in the year. So the very metrics that he used to say that you're supposed to judge him by, he now fails. And of course, he doesn't even mention those metrics anymore. Anyway, the bigger story, though, I think was the failure of the bond market to rally, even though we got weaker than expected jobs numbers today. The yield on the 10-year Treasury barely slipped. It went down to 4.66 from 4.69, hardly anything. And the yield on the 30-year went down a tick from 5.22 at the end of last week to 5.21 at the end of this week. So no relief, even with a drop in oil prices, which fell. Oil closed about 77, so down, I think, for the second week in a row. We were up at $90 a barrel. But now all this talk about a deal, which, again, who the hell knows if there's any kind of deal or if it's, how lousy this deal is going to be. But there's a new ceasefire. They're talking about opening up the Strait of Hormuz, whatever. But all that positive, de-escalation, peace and deal talk, yes, oil prices came down, but not bond yields. That shows you how weak the bond market is. The dollar index was down on the week. Down again today on the jobs numbers. So we closed at 99.6 on the U.S. dollar index. So that basically wraps up, I think, the most significant market moves. But the market reacted to the de-escalation, not just of war, but of the ratcheting down of the expectations for Fed rate hikes. I think now the odds of any rate hikes at all between now and the end of the year, not just between now and September, but between now and the end of the year, it's about a coin toss, a 50-50 shot as to whether or not there are going to be any rate hikes at all in 2026. And that is not only because of the weakness in the jobs market, but because of what happened in Japan. And again, what happened with jobs, what happened in Japan is exactly what I have been predicting would happen with both of those markets. This stuff does not surprise me. I've been waiting for this. I've been warning that it was coming. And this is the week that those forecasts were vindicated, and I expect many more of my forecasts to be vindicated.
Behind closed doors, global monetary authorities are executing a stealth form of quantitative easing through secret repo swap lines with foreign central banks. By absorbing foreign treasury holdings directly and creating billions in new currency out of thin air, policymakers are desperately trying to suppress skyrocketing bond yields and prevent a total debt market collapse. However, this covert liquidity creation expands the circulating money supply, guaranteeing that severe inflationary pressures will return with full force. As foreign exchange volatility accelerates, central banks will be forced into repeated, larger-scale market intervention cycles. This relentless money printing will drive bond yields significantly higher and accelerate the collapse of paper currency purchasing power worldwide. Holding unbacked paper assets through this expanding liquidity trap will lead to disastrous losses for unhedged portfolios. Now, let's get back to the interview.
Japan told the United States that we need to intervene in the currency market. So we got to sell dollars to buy yen, which means we got to sell treasuries to get those dollars. Now, the Fed, probably talking with the Treasury Department, was like, no, you can't do that, right? The bond market is tanking. The last thing we need is big sales by Japan, right, to push it over the edge that it's teetering on. So the U.S. government, right, made a deal with Japan. Said, hey, you don't have to sell those treasuries. Let's just do a repo with us. Let us buy those treasuries from you, and then you can buy them back from us later on, right? It's like a swap. You give us treasuries and we'll give you dollars. So you don't have to actually sell your treasuries to get dollars. We'll just take the treasuries off your hands and we'll give you dollars. And that is what happened. And so the Bank of Japan, or Japan, whatever, got the dollars it needed, not by selling the treasuries, but by giving the treasuries to the U.S. And the Fed just cranked up the printing presses, or created the money that they needed. It was like $10 billion, right? That Japan had to then sell into the market to buy back yen. So this is a form of quantitative easing. It's just that the Fed is not going into the market and buying those $10 billion of treasuries. The Fed is taking the $10 billion of treasuries from Japan and then creating the money and giving it to Japan. And the crazy thing about it is Japan still earns the coupon on those treasuries. So they don't have to sell the treasuries. They get the dollars without selling them. They still get the coupon. So the United States is still paying Japan interest on the treasuries that it doesn't even really have anymore, that it sold back to the Fed. Now, Japan has to pay interest on the money that it borrowed because the treasuries are the collateral. So Japan has to pay interest on that loan, but the interest it's paying is lower than the coupon it's getting. So it's still a positive carry. So it works out great for Japan because they get the dollars they need and they're still making some cash flow on the treasuries that are parked at the Fed. But what do we get out of this deal? The only thing we get out of it is the Japanese don't sell these bonds into the market. The Fed prevents that from happening. Why? Because the Fed is afraid, the U.S. government is afraid that if Japan is selling treasuries, treasury prices are going to fall. And so to prevent that, we create inflation. That is what the Fed did. They created more money, gave it to Japan to use to buy back yen to increase the supply of dollars in circulation. That is more inflation. And in fact, if you look at what happened to the Fed's balance sheet in the most recent week, it rose by over $10 billion. And that isn't even the $10 billion that came from the Bank of Japan. That is $10 billion in U.S. treasuries that the Fed went into the market and purchased. So the Fed is not only doing quantitative easing without acknowledging it, but it's doing it even worse because it's doing it on the part of the Bank of Japan too. And if you think that's the end of the intervention, you're wrong. This is just the beginning. Because if the Bank of Japan keeps interest rates down at 1%, the pressure on the yen is going to continue. And if the pressure on the yen is going to continue, then more intervention is going to be required. Now, look, the last time that the U.S. government intervened to support the Japanese yen was 1998. That was 28 years ago. So this is not something that happens, routinely. And the intervention that they just did was 10 times bigger than what they did in 1998. So the scale is certainly unprecedented. The U.S. government has never intervened to this degree, and the fundamentals haven't changed. The currency speculators can see this. They're going to continue to push the envelope here and sell off the Japanese yen. And so Japan is going to have to keep intervening. But the only way Japan can get money to buy yen is to sell treasuries. Now, we've made it clear we don't want them to sell treasuries, so we're just going to keep the swap lines open. We're going to keep allowing the Japanese government to bring its treasuries over to us and do these repos so that they can get a bunch of dollars that we create out of thin air and use those dollars to buy Japanese yen. Now, the other unprecedented aspect of what just happened is that we didn't even sell dollar to buy yen. We used our euros, not our dollar. So we used up, I don't know, it was probably most of our euros. I'm not really sure. I forget how many euros we've got. I mean, the U.S. has foreign exchange reserves, but they're very small, relative to the size of our economy. And that's because, we don't think we really need FX reserves. After all, we got the reserve currency. So why do we need other reserves? Why the hell do we need euros or yen or pounds? Well, we can create all the dollars we need. Other countries have bigger foreign reserves because they don't have the reserve currency. So they need our currency as a reserve against theirs. But we don't have to reserve against our currency because our currency is the reserve. But nonetheless, we have foreign exchange reserves. Well, instead of using dollars to buy yen, we used euros. Now, why did we do that? Because I think that the U.S. government was afraid to use dollars because that would have driven the dollar much lower, which probably would have driven bond yields higher because selling dollars would have been more inflationary because of the implications for the dollar. And so the U.S. government decided to do this intervention this time using euros. Now, there's a limit to how long we can use euros because we run out of euros. Now, we don't run out of dollars because we can print as many as we want. Of course, what they're going to be worth is a whole different story. We can't determine what they buy. We just can create as many as we want. The market doesn't have to accept them. But, the ECB had no idea this was happening, right? They were completely blindsided. So the Fed didn't give them a heads up, right? That, hey, or the Treasury Department didn't say, look, we're going to be selling the euro, no offense, guys, we don't mean anything by it, but we're going to be dumping your currency so that we can help out Japan and prop up the yen, because they found out about it when everybody else found out about it after the fact. And obviously, they were not happy about the fact that their own currency was sold off. By the way, the euro rebounded. So this intervention didn't even hurt the euro. But obviously, had the Fed intervened with dollars, the euro would be a lot higher. And so I think that the Fed was cognizant of this. And so they tried to get away with the intervention by using euros.
A dangerous and overlooked rift is developing in global foreign exchange markets after monetary authorities quietly dumped European currency reserves without advance warning to foreign central banks. Utilizing euro stockpiles to temporarily support Asian currencies reflects deep desperation, yet secondary reserve assets are strictly finite. Once these limited foreign reserves run completely dry, central banks will have no choice but to print domestic currency directly, triggering a sharp sell-off in the national currency and unleashing aggressive import inflation. Simultaneously, corporate treasury strategies tied to speculative digital assets are falling apart under the weight of severe shareholder dilution. Executive management teams are now subordinating common equity holders, issuing dilutive debt deals, and selling underlying crypto holdings just to meet fixed preferred dividend obligations. This aggressive equity dilution will decimate common share values, while digital tokens continue lagging behind hard commodities. Investors clinging to heavily diluted corporate stocks face severe downside risk as capital rapidly rotates back into tangible gold, silver, and high-margin mining equities. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.